Have you ever wondered what expense ratios are when it relates to mutual funds? Have you ever wondered what load fees are as it relates to mutual funds? How about alpha? That's just financial jargon. Have you ever wondered what that was about? How about what accounts to use when you're doing income planning? And have you ever wondered what Roth recharacterizations are? Very important to know. Well, folks, stay tuned because we're going to be talking about all these things today.
Retiring Well, brought to you by Centennial Wealth Advisory, financial advisors specializing in retirement planning and serving all of Northern Michigan. Retiring Well, helping you plan for a successful and comfortable retirement. Retiring Well, plan to retire well.
What are these expense ratios you find in mutual funds? An expense ratio is simply the general and administrative costs associated in running that mutual fund. It's their research costs. If they're running a fund and they've got an objective, then you want them doing the research as they study the companies and securities that they're putting in that mutual fund, right? It's their advertising costs. Folks, these costs are generally published in the prospectus that they have to give you. That's that little booklet that's got all the details about that mutual fund. You know, what is its objective? You know, what kind of securities is it holding? What's their strategy, right? And in there is going to be this expense ratio that they're going to tell you what those costs are. Now, in 2013, Morningstar did a study and they found that of all the mutual funds, they pretty much averaged about 1.25%. Now you're going to find sometimes mutual funds with much lower costs, especially if there's not a lot of trading associated with it, and you might find some that are higher, but they found the average to be about 1.25%. Now Barron's did a study in 2013 as well, and they found out of 1,800 mutual funds that they found this study did, they found that where the average expense ratio was 1.19%, the corresponding hidden costs were 1.44%. So, you ask, what are these hidden costs? Well, they're going to be the transaction costs associated with the buying and selling of the securities within the portfolio. You got to understand, when they go out and buy a security, there might be fees and commissions associated with that buy. And the same thing on the sell side. Well, those costs aren't going to be disclosed separately. They're just going to get attached to the securities they're buying and selling. So, just knowing that those costs are there is something you're going to want to know. Now, how do I know how high those costs are? Well, you're not going to know. But one clue might be if you look at the turnover ratio with that mutual fund, meaning how much buying and selling they're going to do. Well, there's reason to believe that one that's turning over much more is probably going to have higher transaction costs than one that's not turning over a lot. So folks, we can get behind these mutual funds and we can tell you, what the average expense ratio you're paying is in your mix of mutual funds, and we can tell you what those turnover ratios are within those funds. Isn't that important for you to know? Now, other things we can look at is cross-intersection. When you got mutual funds all owning maybe the same security, when you put those mutual funds together, what securities am I owning? Is there any low concentration of stocks in any one area? So folks, if that's something you want to know, if that's something you want to understand, then give us a call because we can do that for you.
Every success story starts with a plan. The success of your retirement depends on a solid financial plan. If you are nearing retirement or already retired, we invite you to an informative live event to help you plan to retire well. There is no cost and no obligation, and dinner is on us. We are Centennial Wealth Advisory, financial professionals specializing in retirement planning and serving all of Northern Michigan with offices in Traverse City, Cadillac, Petoskey, and Gaylord. Our presentation includes highlights of the Tax Cuts and Job Act of 2017 and the big opportunity it presents over the next 7 years. The surviving spouse tax trap, how can you avoid it? How two similar portfolios can end up with two drastically different results. What's the definition of a bull market? Do you know your risk exposure? And much more. Call 888-608-5825 to register and choose the date and location that works best for you. Thursday, January 23rd at Big Buck Brewery in Gaylord, or Tuesday, January 28th at Lakeside Charlie's in Cadillac. The live event starts at 6 p.m. and is free to attend with a complimentary gourmet dinner to follow, but seating is limited and tends to fill quickly. Call 888-608-5825 to reserve your seats today. There is no cost and no obligation. Don't miss this important live event to help you plan to retire well. Call 888-608-5825 today.
Hi, in this segment I want to talk to you about alpha. Now folks, this is just more financial jargon that in our industry that we use, but it's something that we look for in a portfolio. Now alpha is simply this. It's basically it's usually represented in a single number, okay? And it's representing what a portfolio has done compared to a benchmark, or what maybe a mutual fund has done compared to a benchmark. So for example, let's say that I've got a large cap mutual fund. Now folks, that's just a mutual fund that's holding large company stocks. Now probably the best benchmark to compare that portfolio with would be the S&P 500, being the S&P 500 is the largest 500 companies in the US. So I'm going to look at that large cap fund or portfolio and compare it with the benchmark, which is the S&P 500. Now, if alpha equals 0, that means that that portfolio, that mutual fund, was perfectly matched or performed with the benchmark. So, you know, this one did 7% and this one did 7%. That would give that one an alpha of 0. Now, an alpha of 3, for example, meant that that portfolio did 3% better than its benchmark. Okay? Now, if that number was represented as a negative, okay, let's say -5 was the alpha. That means that that portfolio, that mutual fund, did 5% less than the benchmark that it was being compared to. So can you see how important this is to know? You'll hear a lot of these companies, portfolios, and mutual funds out there trying to say they're trying to achieve alpha, right? What they're basically saying is they're trying to do better than what its corresponding benchmark is. So knowing what that alpha is in a portfolio is very, very important. Now, I've talked before on what is another financial jargon or name called beta. Now, beta is just simply how volatile an account is. All right, so a beta of, like, let's say 0.8 means that it's 20% less volatile than the portfolio it's being compared to, okay, or to that benchmark, I should say. A beta that's over 1, you know, means it's more volatile than the benchmark that it's being, you know, compared to. So knowing alpha, knowing beta, these are very, very important things that you're going to want to know when you're looking at a portfolio. We have the tools to get behind a lot of these portfolios, these mutual funds, and actually telling you what those two things are. If that's important for you to know, then I encourage you to give us a call and we can tell you what those are.
You know, thank you, Larry, for that educational piece. Those are two topics that I think often get overlooked, especially expenses. You know, those of us out there, you know, it's really, we want to know what we're paying for something. This isn't a non-profit industry in this investment world. You know, Dawn, when you're out buying something, I can only imagine you want to know what you're going to pay, right?
Absolutely, yeah. I mean, just recently I was doing some shopping. I need snow tires. We live in northern Michigan. You know, snow tires is an important thing. And in calling from place to place, how much did the tires cost? Well, it cost this, you know, set amount of money. Okay, great. And when you go to actually pay, oh, well, then there's this service fee and there's this maintenance fee. You know, whoa, I thought I was paying this. And so now I've begun to be a little bit smarter in how I shop around, because is that the bottom line fee? You know, that's kind of where I've started to go, because different places talk different prices, and it gets confusing at times.
Absolutely. And I can only imagine you're talking about buying snow tires, and obviously it's very important, especially here in northern Michigan, but something investments. You know, you may have these investments for 30, 40, 50 years and planning up for your retirement. It's important to know what you're really paying, especially those costs you may not be seeing. You know, here at Centennial Wealth Advisory, we believe in transparency. We want you to know exactly what you're paying. We do have to make money off of this, and we're okay talking with you about that, but we want you to know what that cost is, and you should know what that cost is. You know, Larry, with these funds out there, to me it's just frustrating that people don't always know what they're paying.
Yeah, well, you know, as I indicated in the segment, you know, the mutual funds have to publish some of the costs, right? It's in that prospectus, and a lot of advisors, you know, will give those prospectuses to the clients. A lot of times the mutual funds will mail them out to the clients once a year. But I've been hard pressed to ever find anybody that actually read it, you know, but they're in there. But the thing that surprised me is that the study Barron's did that I talked about, where, you know, you've got these published costs, but these hidden costs were actually more than what was published. So that was quite surprising. Well, folks, I want you to stay tuned, because in the next segment, I'm going to be talking about income planning and the kind of account you want to use when you're doing that planning. So stay tuned.
Are you retired or approaching retirement in the next 5 to 10 years? Join the Centennial Wealth Advisory team for an exciting presentation with complimentary gourmet dinner and learn essential financial strategies for a comfortable retirement. Call 888-608-5825 to reserve your seats today. There is no cost and no obligation. Call 888-608-5825.
Hi, welcome back. Listen, in this segment, I want to talk about income planning. Okay, one of the biggest questions people have when they're taking income, if they're at retirement, is this money going to last? Very, very important. And we want to set a plan ahead of time so we can plot that out based on what your income needs are to make sure that you're not going to run out of money before you die. Very, very important. Now, as a general rule, when you're developing an income plan like that, you want to be dealing with low volatile accounts. You know, we've talked about this before. If you're taking 4 or 5% for income, that's what you need, and we can grow that account by, you know, 5, 6%, well, then that's going to work all day long, because I'm just pulling the cream off the top, right? But if I'm that person that needs 4 or 5% income and the market drops to half its value, now that 4% becomes 8, 9, 10%. How am I going to grow it back? I now forever got to get better than 10% rate of return to even start to grow that portfolio back from where it fell. So very, very important. If you're doing income planning, we better be dealing with low volatile accounts. The other thing we want to do in income planning is make sure that we grow as much as we can possibly do, grow those guaranteed accounts. You know, if I'm somebody that has very little or no pension at all, and I've got Social Security, then growing that Social Security benefit is going to be a huge part of this. You know, as you're aware, you can take it at age 62, you can take it early, but if I can wait, if possible, if I can wait as long as possible to get to maybe age 70, I can just about double that benefit. That's a huge thing if that's my only guaranteed source of income coming in. So in income planning, you know, you want to deal with low volatile accounts from your savings, but you want to grow those guaranteed accounts as well. It's going to help us in the income planning. Now, I want you to be careful. I've had a lot of people out there, they'll go to an advisor, they'll get an income plan, okay? A lot of times it'll be this thick, and they'll go, hey, based on this plan, the advisor told me that I can live to 110 and my money will never run out. I'm all good. He said I'm fine. We have to understand in those plans, there was a growth rate assumption put in there, meaning they had to assume some rate of return that they figured that portfolio was going to grow by as you were taking income. Now, not to make this oversimplistic, but think of this. If they put a growth rate assumption in there of like 5, 6%, and they said you could live to 110 and never run out, you understand that that has to make 5, 6% every single year. That's the assumption they put into that plan. Is that the way markets work? Absolutely not. I encourage you, if you're somebody that's not done that income planning yet, or you want answers to some of those questions we talked about, I encourage you, give us a call. This is what we do for our clients, especially those that are near or in retirement. So give us a call. Thank you.
Thanks, Larry. I'm really happy that you brought up the income planning. You know, back in '08, I was working in the hospital and the medical field, and I talked to a lot of people then who were in that retirement phase. And here they are in '08, and they've lost almost all of their retirement. And just hearing their stories as I was at their bedside, listening to them struggle and have the stresses about what am I going to do with my income at this point? I've lost my entire retirement. Income now is a huge piece, and here they are laying in a hospital bed, and that's just a tough story to hear. So
no, you're absolutely right. You know, we see people every day come in, you know, and they're experts in their field that they grew up, you know, whether they were engineers or teachers or doctors, you know, absolutely professionals that knocked it out of the park in their careers, but they have this pot of money that's on this 401k statement or IRA statement that they're supposed to now take in that and turn that into a paycheck for the next 30 to 40 years potentially, and left sometimes without guidance, you know, and that's so often we see people fall short with this income planning, either A, taking on too much risk, or B, just underestimating their life expectancy. You know, we talk to people, I think it's common, oh, I'm not going to make it that much further. Mom and dad died when they, you know, in their 70s. I got maybe 10 years left. Oftentimes, you know, we have clients that are 100 plus years old now, you know, that need to stretch this retirement plan with for health care, long-term care, taxes, you know, family members, all these things that come up along the way, and then also just to do the things you've worked so hard for in retirement. It's really key to have a plan in place. Here at Centennial Wealth Advisory, that's one of our, I think, joys here that we get to do is map out plans that help people retire well and that they can live comfortably knowing that some of that pressure is off them, and they can, instead of just looking at that big balance on the statement, that they can truly believe now that they can retire and do those things they want to do.
Yeah, the challenge, guys, is when, you know, back in the day, you know, let's go to 1980, the treasury rate was just under 16%. You know, people could move from stocks into fixed income accounts and get some pretty good rates. You know, fast forward to today, and they're lucky they can get 1-2%. So more people are taking more risk in the market because they want that growth, but they're taking much more risk than I think they really feel comfortable with. So very, very important if you're getting near retirement or in retirement and you want to see how you're positioned to make sure you're not taking more risk than you need to, then I encourage you to give us a call. If you're retired or approaching retirement in the next 5 to 10 years, join us for an informative live event. This event is all about you, the challenges you face, and the information you need to help you build the future that you want. There's no pressure to become a client. Our goal is simply to give you valuable information that you can use to make smarter financial decisions. We hope that by the time you leave this event, you'll be one step closer to your retirement goals. Listen, in this segment, I want to talk about that Tax Reform Act we got in 2017, right? That gift we got about 1.5 years ago. Listen, there's a couple things that came out of that I think are very important for you to understand or know. First of all, they doubled the standard deduction. Remember, that was that number that they gave you. If you could not itemize, you could take it. If you were married, that was like $12,000, okay? But they've doubled that. Now it's $24,000. Last tax season, we saw a lot fewer people basically itemizing their deductions because they couldn't get over that number. Now, why is that important to know? Well, if you're somebody that cannot itemize your deductions, but you're giving to charity, okay, you're most likely not getting a deduction for a lot of what you're putting into charity. But if you're older than age 70 and a half, okay, you're now at that place where you're required to take minimum distributions from your IRA. Did you know that you can give those RMDs to charity and it never counts as income? Think about it. You know, before I have to take the RMD, I have to take that distribution from my IRA, I have to pay tax on it. Now I give it to charity, I can no longer get a deduction. Not necessarily a great scenario, but if I can take that RMD, give it directly to charity, and it never shows up in my income, well, wouldn't you want to do that? Of course you would. Now, another thing that happened out of the Tax Reform Act is what they called these Roth recharacterizations, okay? What this is if you did not know this, you have the ability to convert any amount of IRA over to a Roth IRA. There's no limits, and there's no income limitations as well. I could have $1 million in an IRA, pay the tax on it, convert it over to a Roth IRA if I wanted to. Now, you could always do these before the end of the calendar year. But if you thought it was a bad idea for some reason, you had all the way to the second extension filing date to undo it, to basically recharacterize it, as they call it, act as if it never happened. Now you say, Larry, why would I do that? Well, think about it. If I'm that person that had $1 million in an IRA, paid the tax on it, converted it all over to a Roth IRA, and now the market drops to half its value, I'd feel pretty stupid, right? I just paid tax on $1 million, and now it's only worth half that. Well, under the old rules, I had all the way, again, to the second extension filing date to undo it or recharacterize it. With the new Tax Reform Act, we no longer have that option. If you do a Roth conversion in the calendar year, you're stuck with it. So the kind of accounts we're going to want to use when you do those conversions is going to be very, very important. If you got anything out of this segment, can you see where a little tax planning would be helpful? At Centennial Wealth, we do that. So if you have any questions regarding Roth conversions or want to know if you're a candidate for it, then please give us a call.
Hi there, my name is Nick Greenman. I'm one of the financial advisors here at Centennial Wealth Advisory. Brand new to the Gaylord office. I'm here full-time now, and also be commuting back to the Petoskey office as well. I'd love to hear your story and learn if I could help you manage your retirement needs.
Every success story starts with a plan. The success of your retirement depends on a solid financial plan. If you are nearing retirement or already retired, we invite you to an informative live event to help you plan to retire well. There is no cost and no obligation, and dinner is on us. We are Centennial Wealth Advisory, financial professionals specializing in retirement planning and serving all of Northern Michigan with offices in Traverse City, Cadillac, Petoskey, and Gaylord. Our presentation includes highlights of the Tax Cuts and Job Act of 2017 and the big opportunity it presents over the next 7 years. The surviving spouse tax trap, how can you avoid it? How two similar portfolios can end up with two drastically different results. What's the definition of a bull market? Do you know your risk exposure? And much more. Call 888-608-5825 to register and choose the date and location that works best for you. Thursday, January 23rd at Big Buck Brewery in Gaylord, or Tuesday, January 28th at Lakeside Charlie's in Cadillac. The live event starts at 6 p.m. and is free to attend with a complimentary gourmet dinner to follow, but seating is limited and tends to fill quickly. Call 888-608-5825 to reserve your seats today. There is no cost and no obligation. Don't miss this important live event to help you plan to retire well. Call 888-608-5825 today.
Hi, welcome to Chalk Talk. Listen, in this segment, I want to talk to you about load fees in mutual funds. Now, as I show you this, I want you to understand that all load fees are different, but hopefully it'll give you kind of a feel for how these commissions are charged based on the class share you're in. Now, most mutual funds, you'll see, they'll describe the mutual fund, and then following it is like an A, a B, or C. That's the share class or the mutual fund you're in. So knowing this is very important. So out there they have what they call A shares. Okay, now A shares typically have a front load fee. And just as an example, I'll show you that they can be maybe 4 to 5% up front. That means as you put money in the mutual fund, there's a commission or a sales charge being charged right up the front that's coming off it, which is maybe 4 or 5%, for example. Then they have what they call an annual commission, or what they call a 12B1 fee. Typically on these A shares, that might be maybe, 0.25%. Okay, that's just their annual commission they're going to charge on that share class. But there's usually no backload associated with it, meaning you pay the commission up front, that maybe that 4 or 5%, you have your annual commission, but then forevermore you don't have any commissions other than that 12B1 fee. Now there's what they call B shares. Okay, now B shares are where you pay nothing on the front, there's no front load, okay? But the annual commission or the 12B1 fee might be, let's say, for example, 1%. Now again, that can be different, but just as an example, that's what it might be. But then there's what they call a backload, meaning depending on how long you've been in, it could be 4, 5, 3, 2, maybe 1%. Meaning once you get to a certain period of time, let's say 5 years, then there's no longer associated with it a backload. But you now have an annual commission coming off, which is still maybe 1%. Now, there's what they also call C shares. Now, where you have a C share, there's nothing up front, okay? There's nothing on the back, but there's maybe an annual commission, again, of maybe 1%. Now, some might say, why wouldn't I do a C share over a B share? Because I got no backload. Well, understand that most people that go into C shares, they're in it for just temporary reasons, okay? And so they just want to be in the account and out, and so they don't mind just a commission being charged while they're in of the 1%. But they don't want to see a front load, back load. Now, an account like that is going to have much more in cash because people are coming in and out of it, might not perform as well as an A or B because it's not fully invested. Now, for retirement accounts, most people want to do A because they're in it for a long period of time. They don't mind paying this up front on the deposit, but forevermore just pay 1/4%. So hopefully this kind of gives you a feel for these class shares and how they charge commissions. If you want to understand your portfolio and want to know what your share class you have, then give us a call.
Larry, let's talk about taxes. It's a big deal. For me, I know if I can save anything, tell me how, right? It's one of those things I want to know more about because I know it's an issue out there.
Oh, you're not alone, right, Dawn? I mean, I think for most people working their whole year, they understand they got to pay them and they get somewhat what they're going for, but it's frustrating, especially those, when you got to physically write the check to the IRS at the end of the year if you don't get a refund or whatever it is. What Larry talked about in this thing is tax planning. When you're working, there's a big piece of it. A lot of people don't pay a lot of attention to it because it's got, it's the withholdings and stuff just coming out of the paycheck. So you don't see it every day. But in taxes, a lot of people have these IRAs, these 401ks. There's big tax burdens behind those. As you take those out, they're going to be taxable. So right now, there's maybe some opportunities out there to potentially save a few percent, if possible, in each individual circumstance. It's the best if you don't have a tax plan right now and you're not talking to your financial advisor about that every single year. Now's the time. I can tell you that it's there's a lot of people out there that are kind of just waiting waiting for that tax hit to come, and don't be that. Take action now, and maybe you can save a little bit on your return next year.
Yeah, I think you guys heard that new Secure Act that just got passed by the Senate. As of the airing of the show, has not been signed by the president as of yet. But they just moved the RMD, the required minimum distributions on IRAs, to age 72 instead of age 70 and a half. What was surprising to me about that is I never could get what that half year was about. They got the 10% penalty if you take it before age 59 and a half, and then they had these required minimum distributions you had to take at age 70 and a half. I was kind of nice to hear now they got a round number. So anyway, hope you found that valuable. I encourage you, if you need any help with that tax planning, you want to know how much risk you're taking, then give us a call.